In market news now, commercial property group Vukile Property Fund reported that its half-year distribution per share of funds from operations rose 5.2%. Vukile, which owns shopping malls in rural townships and urban areas, said footfall at its shopping centres increased to 102% compared to the previous year. Meanwhile, the dollar index was flat against a basket of global currencies. This comes after dovish comments by the Fed has markets believing that interest rate cuts may come in the first half of next year in the world's biggest economy, and of course placing a drag on the dollar. However, we have seen the rand strengthen somewhat, reaching around 18.53 as a result of those dovish comments. And those comments came out of Fed Governor Chris Waller, who has established himself as one of the hawks when it comes to Fed speak that we have been monitoring at least over the past year and a half. So what he did indicate is that he seems to believe that high rates have played a role in bringing inflation down, and as a result of that, we could see the Fed having to not raise rates any further this ahead of that December Fed meeting. However, to give us more perspective on that, we are joined by Patrick Matidi, who is the head of equities at Aluwane Capital. Patrick, thank you so much for your time. I mean, let's get market sentiment now as a result of those comments coming out of Chris Waller, the Fed governor, creating a bit of a dovish pivot here, given the fact that he has been known as quite hawkish.
Yeah, good afternoon, Natasha, and thanks for having me. Indeed, when we look at the month of November to date, we are set for one of the best months, I think, since 2020. So month to date, we were up about 8.5%. Which is quite outstanding, given that August, September, and indeed October, were negative months from an equities point of view. And that sentiment is playing across all asset classes or all financial markets. So we're seeing not only the equity markets domestically, but even globally. We're seeing good gains coming through, but also that is playing out into the bond markets, both domestically and globally, where we are seeing our bond yields coming down quite strongly, all being driven by this change in sentiment, from higher for longer to perhaps, a cut in the Q2 of next year.
Speaking of next year, or rather a year coming in a little bit better than expected, Naspers saying that they're expecting the businesses outside of Tencent to reach profitability earlier than expected. What do you make out of comments coming out of Naspers?
Yeah, and unfortunately, this has been a while coming. You'll recall that it actually cost the previous CEO his job, the inability to turn, this e-commerce business around into profitability, especially given the amount of capital that had to put in. So that story continues where you're still getting promises of profitability to come. I think hopefully we're getting closer, especially since they have actually sold off, some of the non-profitable businesses or those that do not feel they can get to scale without putting in any additional capital. But by and large, the story for Naspers process remains Tencent. So we saw what that did a few weeks ago when they reported. And obviously, they continue to buy back shares, which is fairly positive, at least from a share price support point of view.
The one other company that caught my attention happens to be Pepco, where we saw headline earnings per share down 8.7% and as a result, a lower dividend. However, the one line that did catch my attention is that they are also one of the other retailers seeing disruptions as a result of these port delays. How concerned are you about the retailers that are having to spend more money to fly goods in because they can't get the goods in any other way?
Yeah, unfortunately, that just adds to the cost of doing business, especially going into this busy festive season where you do need to have adequate stocks on shelves. So we're seeing that play out across the different retailers. I think it was also Woolies at some stage also had that concern. But we saw also what that meant for the life of Bidvest, where volumes are down and therefore earnings are down from the port side of the business. So it is one other stain in terms of the ability to do business. Initially, we worried about load shedding, but then now you have the logistics issues coming through, and those are also adding to the cost of doing business, which is not a great thing.
I mentioned in my intro that dovish tilt from Chris Waller, and of course we are looking ahead to that Fed meeting December 12th to the 13th. But when we talk about these Fed cuts that the market is expecting, if you had to consider the threshold for those Fed cuts, what kind of data do you need to see both from South Africa, the SARB, and the Fed in order for you to believe that, you know, these cuts can happen?
I think to start off domestically, I mean, the SAB or the MPC has been very clear that their mandate is to fight inflation, and they've got a 3 to 6 range, and they tend to want to be comfortably within the midpoint of that range before they can consider cutting. So we're still a little bit far away from the 4.5%, but we definitely are getting there if you look at the trend over the last couple of months. So on the domestic side, I think the MPC, just given the stance and the posture and the messaging over the last few months, I think they'll want to be comfortably within the band before we can start to actually price in rate cuts. On the Fed side, it's slightly different. So the Fed, they've got a different mandate. Yes, they do also target inflation. I think the target is 2%, but they also have a growth, sort of mindset that they do watch quite closely. And there's, I think, so far so good. Growth is still holding up. Yes, inflation is still above the 2% threshold. But once again, I think all these central bankers will be guided by data to come out in terms of when to cut. But certainly, if you look at the path of travel, where we are getting inflation coming in lower and lower, the expectation is that by at least Q2 next year, we should be a lot closer to 2%, which will then give the Fed at least some flexibility to can consider cutting.
Patrick, I would have loved to get into conversation with you to look at next year, given that it's going to be a political event, given that the markets will be paying attention to not only U.S. November elections, but also elections coming out of South Africa as well as Britain, but also to get a sense in terms of what are you taking comfort from, especially in this environment, and how are you thinking about positioning as we wrap up 2023 going into 2024. However, we have run out of time with Patrick Matidi. And as you may have been following on our markets update, we are going to be paying attention to that OPEC Plus meeting that's taking place online. Right now, the oil price trading at $82.39 a barrel. We did see that meeting being moved from November 26th to tomorrow. And some of the things that they need to be outlining is going to be policy for 2024. We did see some disruptions in terms of agreeing on quotas coming out of the African countries.